That was the correction? 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
The sell-off in big tech easing this morning as investors pulled back from the biggest winners of the AI boom.
Meanwhile, Wall Street bonuses are set to jump for the second year. Market volatility fueling trading demand, and deal making makes a comeback.
Plus, fresh momentum. Democrats score big wins in key races across the country with Zoran Mamdani making history right here in New York City.
I love that. The big sell-off that didn't happen was 1% and a little bit of change.
Yeah.
Some of the tech giants, though, still in pain this morning. Yesterday was Palantir that had earnings that were fine, but the stock sell-off. Today was AMD, though not as violent as we saw for Palantir. Shares down 2.2% in the pre-market. It was a mixed report. It disappointed investors. Shares had soared 58% in October. The CEO reiterated that the market for AI processors would generate more than $500 billion a year, Matt, but that wasn't enough for a rally.
Yeah, no, they beat expectations. Even the outlook beat what analysts were looking for, and yet investors were disappointed. McDonald's is bucking the trend we've seen from fast food earnings. It reported faster than expected sales growth as diners spend more money in each visit. However, lower income traffic fell by nearly double digits. You can see McDonald's right now up 1.4% in the pre-market.
Back to the big tech earnings with AMD disappointing, even though some of its figures were strong. Bloomberg's Ryan Vasletica joins from and covers the sector and joins us from Chicago. Ryan, great to see you this morning. AMD, is this just another example of expectations very high for reporting?
Good morning. Thank you for having me. So yeah, I would just note that going into this report over the month of October was the best month for these stocks since early 2001. So obviously that's a huge run up in the shares, and it's hard to imagine what kind of results they could have delivered that would have extended gains from there. Like you said, the report was pretty strong. The outlook was pretty strong, but following a move like that, people want to call this some kind of basic buy the rumor, sell the news sort of thing. I think that would apply here. These were pretty strong results, but like you said, the stock just moved up so dramatically that maybe just a little bit of profit taking.
Yeah, I mean, I was reading the results yesterday on the close and the outlook. They expect $9.3 to $9.5 billion in revenue. The estimate was only for 9.2. So it's not like analysts had been predicting more growth. However, they're growing more slowly than their much bigger rival, NVIDIA, and that seems to be the concern, right?
Yeah, that is a big concern. NVIDIA still has a huge percent of the market share here. I think it's over 90%, so they are by far the dominant player. They continue to announce all kinds of major deals. Their technology is widely seen as better. I mean, AMD is catching up in some critical ways, and I know a lot of the big chip customers are hoping to have multiple options to choose from, but right now it is still NVIDIA's market for the most part. AMD is catching up a little bit. The results are getting stronger. They are pointing to some pretty good growth prospects ahead. I think if you're looking at the stock and wondering, is this the end of the AI trade, that is absolutely not the case. But certainly, people are pulling back a little bit here. People continue to see better prospects in NVIDIA. I believe NVIDIA's multiple is lower. So there's a lot that you would probably put into that column over AMD's.
All right, Ryan, thanks so much for joining us. Ryan Vlastelica there talking tech. Turning to consumer earnings. It's a name that you have to say over and over again.
Thank you,
Vlastelica. And when you do get it right,
sticks.
You'll never forget it. McDonald's reporting faster than expected sales growth in the third quarter at the same time as Cava cuts its full-year sales targets. Let's get a read on two restaurants with Bloomberg's market correspondent Nora Melinda. And Nora, it's not just Cava. Like a bunch of these fast casual chains have really disappointed, while the OG McDonald's seems to be beating.
I liked that fast casual thing you did there. We are seeing a bifurcation between the fast casual and the fast food restaurants because there clearly is a difference here. You're seeing the likes of Chipotle, of course, Cava, as you're mentioning here. They're struggling here. I mean, of course, you're seeing a lot of consumers that are being very tight with their wallets, and they're really picky about where they want to spend their money right now. So you are seeing companies like McDonald's being a bit beneficiary here. But it is important to note that even though McDonald's is reporting earnings that people are happy about, they also did have to use a lot of deals and discounts to entice buyers. So you are seeing a lot of people running toward the lower end, what's affordable right now, and trying not to spend too much time on the fast casual restaurants that tend to be a little bit pricier.
I say there was a headline coming out from McDonald's earnings call saying lower income traffic fell nearly double digits. So what's good for McDonald's isn't necessarily a good sign for the consumer.
Absolutely. I mean, we're seeing a time period where, of course, we are seeing a lack of economic data. So people are really parsing earnings to get a read of what the U.S. consumer is doing right now and how they're holding up in this environment. But if you take a look at the earnings that we've seen from a lot of these consumers, these consumer companies, we are seeing a consumer that is very stretched right now. They're grappling with high costs that, of course, tariffs are also filtering into the equation here. So you're seeing people running toward whatever restaurant makes sense for them. And of course, I'm sure some people cooking at home.
It is just fascinating to watch what's going on in the restaurant space and to see McDonald's doing this well as there's a boom in these GLP-1 drugs, right? Because you know, if it's not lower income that's eating there, people with higher incomes are avoiding that kind of food. Like, who is going to McDonald's?
Right. Well, I mean, people are clearly going there for the deals and discounts, and that's what they're pointing out here. So you can get a burger and then add one for $1. So they're finding ways to make it cheap, enticing, more affordable for all ranges right now. And as you mentioned, you know, the lower income consumer is what we typically think of when we think about a company like McDonald's.
Yeah.
All right, Nora, thank you very much. Maybe some people are migrating down to McDonald's and it's not just lower consumer anymore. Maybe someone who would have gone to Kava is now going.
I just feel like if you eat McDonald's in my car, you're never getting a ride with me again, right? And then I have to dry clean everything. Yeah, it just stays forever.
How about like a nice tuna fish sandwich
there
in the back of your car? You're
cool
with
take
that?
instead. Okay.
Nora, thank you so much. Nora Melinda from our markets team. Now, from Main Street to Wall Street, bonuses are expected to jump for the second year in a row. Compensation consultant Johnson Associates says market volatility and M&A are fueling the bumps. Here with us now is Bloomberg Finance editor Sally Bakewell. Sally, I guess not a surprise, right? Just given how strong the earnings were for especially the investment banks of these banking giants.
Right. We had a sense that some good news was coming because most of the banks, the investment banks, they actually posted third quarter results for stock trading that were their best for the third quarter ever. And most of them topped analyst expectations, notching about 15 billion of revenue in that quarter. The clear winner here is stock traders. They have benefited, of course, from the volatility set off by Trump's tariff war, but also by the more than 30% rise of the S&P 500, helped by the sort of optimism surrounding technology and surrounding AI. But across the board, bonuses were generally up for debt underwriting, for wealth management, and for M&A, as you know, Trump's sort of more relaxed regulatory approach has led to a lot of expectations that the deal boom is coming back.
Yeah, so this is a lot of it down to lower regulations. People have the courage to go into this market and make acquisitions. Who's doing poorly? Is anybody missing out?
Well, the retail and the commercial banking, the bankers there, they're expected to see bonuses flat or to 5% or 5% up. So I think obviously there is some, you know, it's not completely optimistic and rosy across the board, but it is still a little bit of a jump. And, you know, at Johnson Associates, they say that next year, you know, enjoy the good times while you can, because next year, if the economy slows, this momentum might not be so good.
This report from Johnson Associates also touched on AI. It does feel like a time, Sally, when companies are maybe just using it as an excuse to trim down their workforce, saying it's not because we want to preserve margins and that's why you're losing your job. Oh, it's just technological changes. What did it talk about how these banks are thinking about implementing the technology and what that means to their workforce?
Well, most of the banks have said that, you know, AI is going to revolutionize how they do business, you know, from coding to their workforces. But there are, you know, considerations here of what it does mean for jobs. A lot of banks have said that actually they still need the human element and the human component, and in fact a lot of them you know, haven't slowed down hiring because they are trying to expand technology and make sure they have the AI experts there in the field able to help them.
Sally, thank you so much for joining us on this story. That is Bloomberg's Sally Bakewell. And for more on the pay report, Chris Connors of Johnson Associates will be joining us in the next hour. All right, a check on futures this morning. They started out negative after the worst day for the S&P 500 in nearly a month yesterday. Now we are basically unchanged. We are unchanged, flat completely on the NASDAQ 100, slightly higher on S&P 500 futures. The Russell 2000, that has a much better day, up 0.3%. After everybody was warning about valuations, I guess valuations don't matter today, Matt.
Yeah, no, I mean, maybe less. Right? You got to buy the dip.
Or maybe like 1% was good enough to buy the dip. What a huge dip it was.
Let's take a look at some of the movers on our radar this morning. Bank America laid out new financial targets, forecasting that earnings per share will rise at least 12% over the next several years. And Bank America is now moved into the bottom slot of all the big U.S. banks over the last 5 years. If you run your comp function, you'll see B of A has done the worst.
Speaking of companies that are struggling compared to their peers, Novo Nordisk again cut its forecast. This was the fourth time this year they've seen lagging sales of Wegovy and Ozempic, which speaks to why they are fighting over Metsera versus Pfizer.
I don't understand. Like, there's so many people who need this.
I know. Well,
there's 100 million people who are obese in this country alone.
Well, remember also when Novo Nordisk had kind of the monopoly. Like, they were supporting the Danish economy. They were doing so well. It's been such a change in fortune with the competition.
And yet, I mean, and it costs multiples more than signing up for ChatGPT, right? And yet OpenAI has a much bigger valuation. Anyway, Lyft riders in the U.S. will be able to earn United Airlines miles starting today. Miles can be used to redeem Lyft rides starting next year. And as a result, or maybe just coincidentally, we see both of these shares rising.
Good luck, though, getting on an airplane that isn't horribly delayed with those Lyft points. All right, coming up, a historic victory for Zohran Mamdani here in New York City. We're live from City Hall. That's coming up next. You're watching Bloomberg Open Interest.
Getting out of high interest, look at what's making headlines around the world. Democrats notched their biggest wins since President Trump's return. Of course, it was the first election day since then. But they had a decisive victory in Virginia, where Abigail Spanberger reclaimed the governor's mansion on a promise to steady the economy and end the longest government shutdown in history. Not sure how she can pitch in there, but her win, rooted in Virginia's federal worker belt, delivered the clearest rebuke yet to Trump's agenda. Democrats also won competitive down-ballot races in Pennsylvania and Georgia. In New Jersey, Democrat Mikey Sherrill becomes the 57th New Jersey governor, defeating Jack Ciattarelli, a former state lawmaker, making his third bid for governor. The Navy veteran and former prosecutor replaces a term-limited Phil Murphy after a campaign focused on affordability and infrastructure, while Ciattarelli leaned on Trump's support and promises of tax cuts. Zohran Mamdani, a 34-year-old Democratic socialist from Queens, was elected New York's 111th mayor. He is the city's first Muslim and first South Asian leader. He defeated Andrew Cuomo with 50.4% of the vote. So we got more than half of what was the biggest turnout in half a century, vowing to tackle affordability with rent freezes, free buses, and higher taxes on the rich.
New York, tonight you have delivered a mandate for change. A mandate for a new kind of politics. A mandate for a city we can afford. And a mandate for a government that delivers exactly that.
For more on the New York City mayoral election, we are now joined by Bloomberg's Miles Miller, who is with us from City Hall in New York. Miles, was this the mandate that Zohran Mamdani was looking for? And if so, how does that change how he governs as mayor?
Yeah, when I spoke with him yesterday, he told me that any win, any victory would be a mandate, but this was pretty decisive, right? It was a 9-point edge on Andrew Cuomo, and this was a race that was really defined by two different visions. One, a vision about affordability for New Yorkers, and another one which was just basically running against Zohran Mamdani. That was Andrew Cuomo's vision. What we know is that he believes he has this mandate for change. How will he get it done? Well, he's already said this morning he is looking at working with Albany to get taxes raised on the wealthiest New Yorkers, and in addition to that, raising the corporate tax rate right now at 7.25%. He's saying raise that to 11.5%. It'll give $9 billion to his biggest proposals: free buses, universal child care, and a freeze on the rent.
So is anyone moving out of New York, Miles? I mean, so many on the right, even in the center, were so angry that Zoran Mamdani was getting so much attention, and they were saying he was going to ruin New York City. Is everything going to grind to a halt here?
You know, it is a different day in New York when you've got Bill Ackman congratulating Mamdani on his win and saying he wants to do anything he can to help make him successful in New York. You've got Jane Fraser and Jamie Dimon saying that they want to work with him on transit and on affordable housing. He's got to build a broad-based coalition to come here to City Hall with him. He'll occupy that office just down the hall in about 2 months' time. And he's got to get a transition team together that reflects New York City. Yes, his labor base. Yes, his DSA, Democratic Socialist base, but also Wall Street and business. Bring them to the fold and figure out how they can work together, because these proposals have to be funded some way.
In Mamdani's victory speech, he spoke directly to the president. He said, "President Trump, as I know you are listening." And President Trump likely was listening. In the middle of that speech, he put out on Truth Social in all caps, "And so it begins." What does this set up for a tension between the President of the United States and the incoming mayor of New York City?
Yeah, you know, it's actually interesting. Let me take you back to when Joe Biden was president, right? He did not have a good relationship with Eric Adams. And so what happened? There was the issue with the migrant crisis happening here. Fast forward to this mayoral race. Andrew Cuomo was making the case that he was the only one who could fight Donald Trump. Mamdani and Donald Trump are going to go head to head, surely, because Donald Trump is saying he's not going to give federal funds to the city. That likely won't happen. There'll be lawsuits and all of that. But you got to think about what Mamdani has also said. Trump, in 2024, you ran on an affordability message. Can we work together on this? Can we work together on grocery stores or groceries being cheaper? Can we work together on, getting the costs down? He's going to try to figure out ways to work with Trump. But of course, it's going to be a big fight when you talk about National Guard and, immigration raids here in the city, something he won't stand for, because that is his broad-based coalition that propelled him to be mayor-elect today.
All right, Miles, great coverage. As usual, Miles Miller there down at City Hall. Catch Bloomberg special election coverage today, kicking off at 12 p.m. New York time on Bloomberg Radio and TV. Coming up, Nancy Tengler trimmed Google and added Palantir to her portfolio. We'll discuss the AI trade with her next. This is Bloomberg Open Interest.
Record valuations, a weakening labor market, dysfunction in Washington, D.C., they were all blamed for weighing on investor sentiment, at least for one day. This week's sell-off, which again is now at 1%, comes as 3/4 of the S&P 500 have reported earnings, with a positive surprise ratio of 82%, on track for the best quarter since 2021. Let's bring in Laffer, Tengler CEO and CIO Nancy Tengler. Nancy, was there anything to yesterday, a 1% sell-off? Because the narrative was we're finally worried about valuations again.
Yeah. No, I mean, valuations are high, so I don't want to dismiss that. But this isn't a strong earnings season. We've seen really strong guidance raises from the companies that we own. So I think that's where investors should be focused. But remember, you've got the algorithms reading the headlines, and so you get these sharp moves. I wouldn't mind a modest correction, but I don't think the AI trade is over. And I don't think that valuations are as wacky as they were in the 1990s when I was not only alive, but managing money.
I was there too, Nancy,
yeah.
Working at Tucker Anthony as an intern on the Bloomberg terminal. So where do you see the most value now? I mean, you have piled into the best performers already, and I imagine you're not going to continue allocating to these mega cap tech stocks. So if you have fresh money, if you have new money now in November of 2025, where are you putting it?
Yeah, well, we've broadened out. So you teased that we trimmed back Google, which we did, and we added to Palantir, which we actually own at much lower levels. But we also added a position in Ulta. We exited CMG or Chipotle a while ago, thank goodness. And we've added to names in the infrastructure space like Quanta Services, Eaton. We own a little bit of Emerson, which isn't quite as sexy as those names, but we've done that over time as we have in financials, broadening out just from the major financial banks like Goldman Sachs and JP Morgan to names over the last couple of years like American Express and BAM. So we do like a number of names, but our real focus, as you know, has been the old economy companies that are embracing new technology. So Walmart's been our poster child. Raytheon is a close second, embracing AI and other cloud and digital solutions. But then the suppliers are the picks and shovels. And while they've run, we do think there's still a trade there for the next 2 to 3 years.
Hey, Nancy, only about a minute here, but I'm just curious on the Palantir trade. Did you do that before the sell-off? And if not, did you add on during the sell-off that we saw yesterday?
We have a full position. We added to it. I mean, our original position is somewhere in the 70 range. We added to it at 175. So even with the sell-off, we're okay. I mean, I think that's one of the things that you have to do as an investor is use volatility as your friend if you're looking at companies you want to own for the long term, and Palantir is certainly one of those.
All right, Nancy, we're going to keep you with us. Nancy Tengler staying with us through the open. It looks like we're going to recover a bit today after the massive 80-point sell-off on the S&P 500 yesterday. Futures right now unchanged at 67.99. NASDAQ futures down a little bit more, a drop of 0.1%. And you can see that the small caps are coming back. So take a look at the SMID trade today. The opening bell right here on Bloomberg next. Moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are doing very little, although not falling by a lot. So S&P futures down 0.03%. NASDAQ futures down 0.1%. Of course, yesterday we saw investors trimming stocks that had high valuations. Those are the big mega cap tech stocks that really move the indexes, and the question was, like, how far could this go? And I guess the answer today is not very far. You have HP ringing the bell down at the New York Stock Exchange, which has really underperformed the benchmark index. It's up only 35% over the past 5 years, but at least you haven't lost money there. Henry Schein, also a big underperformer. Solutions for healthcare professionals. They make like dental stuff, but yesterday the stock was up 10% because they had a good third quarter and they made a deal with KKR that the private equity company could take up to a 19.9% stake in Henry Schein. So that's pretty exciting.
Yeah, it's very exciting. It's like my favorite part of private equity when they do super boring stuff like that.
Boring is better.
Boring is beautiful, exactly. Here's something a little less boring this morning.
I think bald. Bald is beautiful. That's what they say.
Yes, they do indeed say that, Matt. Anyway, away from that, AMD shares falling only just over 1.5%. It had a mixed earnings report that disappointed investors, but the narrative for this one, much like Palantir, was just that the bar was high. They soared 58% in October, so realistically, how could they succeed that level of rally? But again, only down 2%. It's certainly not doom and gloom, Matt.
No, there is some if you look for it in this market, but McDonald's is not one place where you're finding it today. Bucking the trend we've seen from fast casual earnings. You've seen stocks like Chipotle and Cava get crushed. But McDonald's is up. Okay, it's only 2%, but faster than expected sales growth as diners there spend more per visit. They do say that lower income traffic is down sharply. I wonder who else is going to McDonald's, I guess.
Well, they're not going to Shake Shack, so maybe those people are
they're not going to Shake Shack. They're not going to Cava. They're not going to Chipotle, at least not in the way that investors want to see. So I guess they're getting fries and a Big Mac. We're back with Laffer, Tengler CEO and CIO Nancy Tengler. Nancy, what do you think about the consumer? I mean, we hear so much about this K-shaped economy. I know that the top 10% are spending like all the money. But in a country with 42 million people on food stamps, is the U.S. consumer in trouble?
Yeah, that is a big number, isn't it, Matt? And I was sort of surprised when that was announced. I should know that, but I didn't. No, the consumer is still working. The low-end consumer in all of these environments, like inflation and a government shutdown and poor monetary and fiscal policy, they get hammered the hardest. I grew up in a single-income home, during the 70s, and it was brutal. And that is unfortunate because that's the group we should be helping. But in terms of overall consumer, no, I think it actually looks decent. Balance sheets are very strong. The baby boomers are the wealthiest generation, I think, ever in the history of the country. So there is a lot to hate, but there's also a lot to like. And let's not forget that the OB3, let's call it, bill will have an effect on the consumer of about $150 billion in increased tax returns, or tax refunds. So if you look at, it was retroactive back to January, but payroll taxes didn't change. So as people are filing, no tax on tips, child tax credit, no tax on overtime, seniors in some cases are going to get an adjustment. That will drive consumer spending in the first quarter of next year. So I think if we can hang on, that will be a tailwind.
Nancy, it hasn't just been low-income consumers, though, that have been flagged by some of these consumer companies. Your Chipotle talk about this, Shake Shack, and yesterday Kava, that it's younger consumers, that it's Gen Z with an unemployment rate that's twice the national average and facing headwinds. Is there some degree where that's a leading indicator that it begins with youth because they're the last to be hired and the first to be hired, and it could kind of trickle on from there, that you could see some other impacts for the consumer if at the moment the younger cohort isn't spending?
Yeah, no, I do think that's a concern, Dani. And if you look at the effects of AI, we heard yesterday a number of stories that AI was costing jobs, and I was surprised that anyone was surprised by that. It's the entry level jobs. It's the folks that are just getting out of school, and that's how it was when I got out of college as well. I went and applied at a major construction firm and engineering firm in San Francisco, and they gave me a typing test. I went back 20 years later and I was managing all the wealth for the Bechtel Corporation and the Bechtel family. But the point was that you had to get creative, and that is a concern. But the younger cohort, I think, also eats out significantly more than the average family. And so McDonald's, which we own, is an example of a management team that has made the pivot, which Chipotle did not, much as Walmart did when Target didn't. And so you saw higher income customers going to Walmart while Target was floundering around with strategy and a CEO who was definitely not up to the job.
Nancy, can I ask about the Fed? Last week, Jerome Powell sounded more hawkish, said you can't guarantee a December cut. And I noticed that the Treasury Secretary this morning, Scott Bessent, posted jobs are booming. Inflation is falling. Why on earth would the Fed cut into an economy where jobs are booming and inflation is falling? That doesn't make any sense, does it?
No, Matt. And I think, listen, I've been critical of the Fed. I just don't. I feel like they have been wrong at every turning point. I could have made a case that you didn't need to cut again this last time. I could also make a case you did. But the fact is that if what Scott Bessent is saying is in fact true, then of course you don't need to cut. We had 3% inflation and a 5% Fed funds rate in the 1990s. And what drove economic growth was productivity. And as you know, I've drawn the analogy for the last 3 years to the 90s. And I think we are there. We will continue to see productivity improve. And because the job numbers were overstated by 1.7 million or so over the last 2 years, productivity was actually better than reported. So I think, I think that's kind of a war of words, and I don't even know what to say about that.
Maybe jobs aren't booming.
Maybe they aren't.
I mean, he's the Treasury Secretary, so he should have a pretty darn good view of the U.S. economy, right? If the Treasury Secretary says jobs are booming, what are we all freaked out about?
Well, Trump also says that the stock market's going to continue to hit record high after record high, so maybe there is no reason to freak out. Nancy, we won't have you respond to that. You are diplomatic, as always. Laffer Tengler, CEO and CIO, Nancy Tengler, thank you for joining us this morning. All right, let's get a check on your equity market right now, just about 8 minutes into your trading session. Breath has been very bad for this market, but we are looking at a Bank of America stock that is falling this morning. It gave some corporate updates today, and Brian Moynihan has been speaking at a banker investor day saying that consumers continue to spend, that it is up 5% year to date, and also sees AI efficiencies keeping headcount steady. It feels like that same thing of blaming AI for why you're not hiring people or maybe firing more people.
Right. Well, why wouldn't the consumer be spending with booming jobs and falling inflation? Coming up, Mountain launches its AI platform to instantly generate complete ads. We speak to Mark Douglas, the company's CEO, exclusively next. This is Bloomberg Open Interest.
Struggling to hold on to any sort of gain this morning, but it's better than, I guess, the losses and the 10 to 20% correction that the Wall Street CEOs called for yesterday. We are unchanged on both the S&P and NASDAQ 100 as the Russell 2000 outperforms. Let's get you some top calls this morning, some of the analyst action that we are focusing in on. First up, analysts are calling Pinterest quarter disappointing, to say the least. New tariffs, weaker ad spending, all of that weighing on its outlook. Rosenblatt cut the stock on fears that AI chatbots could invade Pinterest space, calling it a, quote, existential risk. Shares are off by almost 20%, a huge drop. Next up, Wall Street is weighing in on Trex results. Analysts say that its forecast signals a costly reset for the decking company. Overhead costs climb back to pre-COVID levels. William Blair cut the stock on concerns of a marketing war, and Barclays warned of cracks in fundamentals. Also a huge drop for that company, down 28%. Finally, Arista Networks' softer margin forecast is drawing a sharp market reaction. That down 5.5%. Analysts, though, largely read it as a typical caution rather than weakness. Morgan Stanley called the results robust, yet noted that they may look muted next to faster AI hardware peers. Barclays pointed to broad-based strength and a typical conservative guide. Matt.
All right, interesting stuff. Can't believe Trex is getting hit so hard.
Very hard.
All right, Mountain is seeing price cuts this morning from Needham and Citizens JMP after its third quarter earnings report. The stock is down 7% since the IPO, but they posted record results. Joining us to help explain what's going on with the stock market is Mark Douglas, CEO of Mountain, and obviously your focus, your strengths are technology and coding, AI. So not an analyst, but what are investors not understanding about your growth?
Well, as you said, we've grown an average of 39% year over year for the last 6 quarters. We had record EBITDA, adjusted EBITDA margins, our first quarter in 4 years of GAAP profitability, and gross margins approaching 80%. So I think the company is growing quickly. It's very healthy. When you look at kind of price targets, one thing to keep in mind, there have been some adjustments to price targets. They've been adjusted to, I think, in a range of the stock growing 80% to 120%. So the average consensus is stock price is going to double over the next couple of quarters. I think macro kind of valuations have adjusted a little bit, so the price targets have adjusted. But basically, analysts are saying this is an incredible buy, and I think when you look at our growth, we feel very, very confident.
Where are you squeezing the incremental dollar from in that record revenue growth? Is it getting more market share, or are the customers just willing to spend more with bigger budgets?
Well, both. So Mountain created the space we're in. So we created this concept of performance television, allowing any size business, small and medium-sized business, to come to TV and use it, streaming TV specifically, and use it like they do performance marketing on Meta or they do it on Google. And to really give you
basically aiming targeting the ads at the people to whom they're most relevant.
Yeah, I mean, it's really simple. When you think of advertising as brand advertising, as performance advertising. Brand means you want awareness. Performance advertising means you want money. It's that simple. And so the biggest market for advertising is performance advertising. As search, social, now performance TV. We created the space. We're the fastest growing company in connected television, expanding margins. So I think the market will catch up. The stock right now is an incredible buy. And I think I'm hearing that from people, actually.
Well, I wonder if people think maybe the company is a buy. I mean, you have this really cool new product, QuickFrame AI, which we're going to talk about.
Yeah.
But, what I hear is that, the Mag 7, these guys have so much money. We hear they're doing deals without even having bankers and lawyers involved because they want to get it out there.
Yeah.
Are people calling you and saying, like, why don't we just take your company over?
Well, I have a lot of partnership discussions. I'm not in any M&A discussions, I can tell you that. But we are partnering across the industry, both with our performance TV platform and especially now with our AI, our creative AI platform that we just made. Yeah, QuickFrame. We just...
Explain it to us.
It's really simple. If you want to create a full professional quality 30-second commercial, you actually can't use a single AI model. You have to orchestrate multiple models together. So our generation times are not like 40 seconds. They're 10 minutes to orchestrate, often like 10 to 20 steps. But you get incredible quality video. Why that's so important, 97% of our customers have never advertised on TV before. So they need commercials. They need them to cost an order of magnitude less to create than it used to before AI. And we've introduced tools that allow them to do that. And the quality is actually incredible. We're partnered with Google, 11 Labs, and other companies on it. When we show them what we're doing with their own generative models, I think they are kind of blown away.
What's the moat then? What's stopping Google, Adobe, Meta, any of these companies from just replicating the same thing you are with their in-house AI power?
Well, actually, I have no problem with them doing that. Our goal is to make sure our customers have access to inexpensive, very high quality, full 30-second quality videos, and that's why we're partnered with them. But again, if one of them can do everything we're doing to orchestrate models across, like we're using Sora and VO and 11 Labs in a single video, plus many other models that are not as well known. If any one of them can do that, great, as long as our customers get the 97% of our customers get the solution they want. But we decided to take a leadership role in creating our own environment. We've traditionally always taken on the creative challenge because it's such a big part of our business.
Let me get your take on this, the AI promise, and will it deliver in terms of ROI, right?
Yeah.
You've been around, you've started a number of companies, you worked for Oracle, and Larry Ellison's done pretty well with this.
Yeah.
Is it worth the trillions that we're talking about investing? Are we going to get the return soon, or is it going to be like a 1999-2000 thing where it takes years and years for us to make this money back?
I mean, it's probably somewhere in the middle. I think every investor in the world does invest trillions, and everyone gets a return. There's ultimately winners and losers, but obviously AI is having a vast impact on everyone's life already. Even on my earnings call yesterday, I have to assume some investors are going to read the AI summary of the transcript of the voice call. So you have to take all this into account. It's having a vast impact on our life. But I think
what about for you? I mean, you're a coder.
Yeah,
are you using it?
Yeah, we are. We're using it across the company. So it turns one out of every two people in Mountain is a software engineer. So half the company's headcount. So it makes it like actually the whole company is software engineers because it more than doubles their productivity. It's really critical. We're using it also in our products. So we talked about the creative AI. Also, the key thing we do is we match consumers with brands they're going to love. And they see these brands they're going to love on the big screen in their home, on their television. And so we're using AI for the targeting, all the models to figure out who's the right consumer to see the ad, and which is really hard for smaller businesses. We're using it in the creative. We're using it in deciding where the ad should be placed. So across our entire business, as well as our own use in sales, marketing. So it's just kind of across everything. We're creative technology, and we're adopting technology.
I just want to know if any actors or film directors followers have called you upset that you're taking their jobs.
You know that Ryan Reynolds is their creative director.
Why is he not upset? He'd be like, it's literally taking his people's jobs.
Well, I think actually the AI is creating more actors because you don't have to be a good actor. We can take an image of you and turn you into a great actor.
Got it. So you just need to look the part now.
Yeah, but the way more to look at it is that when you lower the cost of creative, you actually create more demand. And so we have a network of creators that use QuickFrame. We call it QuickFrame Marketplace. And we're actually creating more demand for their services because they are often involved. When you want to create, you decide today you want a TV commercial, you still have a busy schedule all day. You'd rather still pay someone, can you do this for me? But rather than spending, thousands of dollars, now you can spend hundreds to get that creative using a platform like QuickFrame and using Mountain.
Well, I can't wait to see the QuickFrame Bloomberg Open Interest ad on its way. Mark, it's so wonderful to speak with you. Thanks for joining us. Mark Douglas of Mountain. Coming up on the show, the AI-fueled sell-off has Wall Street wondering if it's a blip or a bubble. The market action today would say blip. That's coming up next. You're watching Bloomberg Open Interest. A check on equities about 20 minutes into your trading day, and we have moved higher, up 0.25% for the NASDAQ. It outperforms up 0.33% after dropping more than the rest of the index yesterday. All the warnings that Palantir showed momentum can't continue and sustain itself. Well, it surely has this morning as the Russell 2000 outperforms. For more on the very short-lived tech wreck, let's bring in Bloomberg Tech co-host Ed Ludlow. Ed, I guess one corner where it's still asserting itself is post-AMD earnings, where AMD shares fall. Is this still a case of just very high expectations, but not necessarily a correction for AI-related stocks?
Yeah, I mean, it's just ticked into positive territory in the last 60 seconds. I don't know what you did, but we're up now 0.7%. I mean, that's exactly right. You go to their outlook for the current period, above consensus, not as high as the most bullish estimates. And a lot of people look at AMD and said, wow, from a news flow perspective or a deal flow perspective, you had an incredible quarter with these eye-wateringly large deals with OpenAI and Oracle and the Department of Energy. But that's not really showing up in the near-term growth outlook. And if you go back to the third quarter, where they also beat pretty handsomely, just as with Intel, they didn't necessarily beat or find that upside in AI chips that go into data centers. It was in their legacy businesses, processors for PC, CPU for servers, exactly the same story that Intel had. So everyone wants just to see a bit more immediately about what AMD is doing to take on NVIDIA.
And it's interesting that I get that AMD, as a smaller competitor, investors want to see it growing faster than the big kid on the block. But they still beat by so much. I mean, their outlook for revenue from 9.3 to 9.9 billion, I should say, is far higher than the estimate on the street for 9.2. So are you seeing this really across the tech universe that you cover, that investors just want to see more, even more than analysts are able to put out in terms of their estimates?
Yeah, I think in AMD's case in particular, not just the year-to-date gain, but even the last 2 months, the stock has been on a terrific run. And so now we're up 0.5 percentage point, and it was slow to get there in reaction to last night's print. But these deals take time. When you talk about compute at the hundreds of megawatt or gigawatt scale, it's years of implementation, and the customer needs to stump up the money for it. That's not showing up in the earnings right now. And there is certainly this recognition, at least on BTech, we get it from the market's voices saying we're at risk of a two-speed economy now, where the technology sector is beating quite handsomely, but it's not enough to pave over the cracks elsewhere in the economy that is giving investors generally more worries. And you're showing Palantir down 4%. That valuation concern is particularly prevalent in software names, not necessarily in the hardware names.
Yeah, K-shaped economy for firms was Torsten Slok's note today. Bloomberg Tech's Ed Ludlow talking to us about AMD. We're seeing a comeback now for those shares after they fell in the after hours. Coming up next, Wilbur Ross discusses trade as the Supreme Court takes on the legality of Trump's IEEPA inaction for tariffs. Plus, BlackRock's quant unit enters its fourth decade. This is Bloomberg. We're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Selloff. What sell-off? We are up 1/3% on the S&P 500, half an hour into the trading day. Even AMD is higher after they supposedly had disappointing results.
Yeah, that was like the warning sign yesterday, right? After the bell. And it did fall in the aftermarket and pre-market sessions, but it's back up now in the cash trade. We have breaking economic data as well, crossing the Bloomberg terminal. Type EcoGo if you like to see that. Right now, we are getting ISM services doing better than expected. Maybe we are in a golden era as, hey, let's bring in Michael McKee right now, our international economics and policy correspondent, to talk just for a moment about not only this data, but the fact that the Treasury Secretary, Scott Bessent, said jobs are booming and inflation is falling, which sounds fantastic.
If only it were true, either one of those things. But the ISM Services Index does come in a little bit better than expected, 52.4. That's up from 50, and the forecast was for 50.8, the consensus there. Prices paid, though, rises 70. That's probably one of the highest in quite some time. I have to look up the historical on that. That compares with 69.4 in the month of September. New orders are up 56.2 from 50.4. Employment, though, is still below 50, 48.2 from 47.2. Make of that what you will, since we won't be getting any kind of pay report on Friday. One of the things that people are looking at these days, guys, is the comments that the ISM gets, because they've been very negative. There's one here that says, uncertainty due to the federal government shutdown has shuttered many non-essential functions. This will lead to project delays and overall hurt our fiscal year 2026 expectations. Activity generally flat month over month, another one said, closely monitoring tariffs, and heightened business activity was due to the fiscal new year budget. I guess they mean with the federal government. So it looks like we're starting off the new fiscal year sort of with a mixed message that the overall service economy is still expanding, but there are cracks.
It seems like the prices paid is what this market is paying attention to. Yields jumping across the curve, up 5 basis points for the 10-year yield, 4 for the 2-year yield. That puts it at its highest since Monday of September 29th. I don't know why the day of the week was important, but September 29th of this year. Michael, thank you very much.
The prices paid is the highest since October 31st of 2022, so Halloween of 2022.
So inflation is not coming down, I guess, in the words of Scott Bessent.
Somebody tell the Treasury.
Maybe jobs are booming, though. That's good news.
Well, because we got, what, 38,000 from ADP, 42,000. Yeah, it's not exactly boom times.
All right, Mike, thank you very much. Bloomberg's Michael McKee breaking down the latest data for us. Let's turn elsewhere in Washington, D.C., where the Supreme Court is set to decide in the coming weeks or months whether President Trump's tariffs are legal, with arguments kicking off just moments ago. Bloomberg Washington correspondent Tyler Kendall is there at the Supreme Court now. Tyler, what can we expect as the arguments begin?
Yeah, hey, Dani, good morning. Well, these arguments just started, and the Supreme Court is looking at 2 key legal questions. One, does President Trump have the legal authority under IEEPA, the International Emergency Economic Powers Act, to impose tariffs? And 2, if he does have the legal authority, is he able to do so without congressional approval? Because as the emergency powers stand, the president is allowed to take action against foreign countries during times of national emergencies. It's just that IEEPA has never been used to invoke tariffs before. And this administration certainly is using it to do just that. About 60% of the tariffs imposed so far this term have been done under IEEPA. And our analysts at Bloomberg Economics say no matter how the Supreme Court case shakes out, there's going to be some big impacts. In fact, there is a sweeping ruling against the administration. We could see the average U.S. effective tariff rate fall from 14.5% to 6.5%. And the Treasury Department could be on the hook for more than $140 billion in refunds. Now, I wanted to point out that the Supreme Court has weighed in before when it comes to the Trump administration, but only on an emergency basis. This is the first time the court is going to hear the legality around an actual policy of President Trump's. And Matt and Dani, at this point, the Supreme Court agreed to hear this case on an unusually aggressive schedule, which is signaling to us they may want to resolve this quickly.
All right, Tyler, thank you very much for that. That is Bloomberg's Tyler Kendall outside of the Supreme Court. And let's continue the conversation with former Commerce Secretary Wilbur Ross. Secretary Ross, thank you so much for joining us this morning. And look, it has been said that even if the court overrules President Trump's use of IEEPA, there are other tools available to him. So what is at stake today if he might be able to accomplish some of the same means, even if not through IEEPA?
Well, the importance of today is if he's upheld, then we're in the status quo. Businesses will be able to plan. Foreign governments will be able to plan. If the Supreme Court, which I do not think they will, but if they were to rule the whole thing was not legal and reverse it, there would be a real mess. And I think it would be very bad, not just for foreign trade, would be very bad for markets, because businesses can adjust to good news, they can adjust to bad news, very hard to adjust to uncertainty. And everybody would know that if he were overturned, he will find some other way to try to reinstitute them. Meanwhile, there would be enormous confusion about refunds. You've heard that there's something over 100 billion has been collected. So one question would be, how do you make refunds if those are deemed necessary, and to whom? Do you make them to the importer who technically wrote the first check? Do you make them to the importer's customers who ultimately bore at least part of the burden? What do you do? These would be unprecedented and very unsettling things.
That's a great point, though.
Especially because in many cases, the other country has already agreed to lower their tariffs in reciprocal nature to deal with Trump's lowering from his original plan. What do you do then? Do those tariffs snap back up to the higher level? Do they stay here? It would be such a mess.
Mr. Secretary,
that I would be very shocked if the court would rule it.
If I can just ask, because you have such great experience in business and in government, it seems that the president believes the countries on which he puts these tariffs end up footing the bill, whereas everyone else understands that it's really the importer or even the end consumer. It's a tax on U.S. citizens. Why doesn't the president seem to understand that, or is he just pretending not to for political purposes?
Well, I think you're not quite exactly stating his view. His view, and frankly my view, based on our prior experience, is that the exporting country generally puts in a subsidy to absorb part of it. The exporter absorbs another part. The importer absorbs part. The retailer absorbs part, and a portion is borne by the U.S. consumer. So I think it's a little bit of an oversimplification to say that the consumer ultimately pays the whole thing. That has not been the experience historically. But more to the point, even if it were the case that the consumer did, to the degree that there's an alternative that's a lower net cost than the particular country with the high tariff, consumers will tend to seek that out. So generally, the impact of the tariff is somewhat muted by that.
Well, Secretary, if I can jump in, because this also speaks to part of what's going on with the case with the Supreme Court today, in terms of what are tariffs for? Is it an emergency? Is it something you use to combat, for example, fentanyl with China? Is it an economic thing that you need to accomplish in order to bring more revenue into the country? Is it for national security? You yourself helped design and negotiate tariffs in the first Trump administration while serving as Commerce Secretary. How do you yourself see the purpose of tariffs in this instance and what the Supreme Court is going to have to think about them as they decide the fate of it?
Well, I don't think the Supreme Court will actually be ruling on the purpose of tariffs. The IEEPA, the legislation on the basis of which the president is imposing these tariffs has one criterion, namely a national emergency. Doesn't say it has to be national defense, doesn't say anything else, just a national emergency. And it also doesn't define what a national emergency is. It simply says the president has to declare that it's a national emergency. So I think there's a good chance that what the Supreme Court will do is not knock out all the tariffs, but go to a few that are a little bit harder to call a national emergency. For example, the high tariff on Brazil because of their treatment of Bolsonaro. It's a little hard to fit that into a national emergency. Or similarly, the province of Ontario running the Ronald Reagan ad criticizing tariffs. It's hard to take things like that and call them a national emergency. But fentanyl has killed hundreds of thousands of Americans. Hard not to say that that's an emergency. Huge trade deficits. Hard to say that's not an emergency. And then finally, you have the question, since it is under the legislation, the president's job to declare the national emergency, if you knock it out, who then is the one who has to call it a national emergency? Is it Congress? Who is it? And what is the procedure? This legislation did not require any detailed process for determining what a national emergency is. So my guess is that if they knock out anything, it'll just be a few at the margin, but that they'll leave the bulk of it intact. I think the court will be well aware of the utter confusion that would come up in the event they knocked everything out. And I think the very fact that Scott Bessent and the U.S. Trade Rep are both going to be not witnesses, not speaking, but present in the court shows the amount of concern they have as to what the consequences would be if the court were to knock them out. And then finally, in most cases, the deal, the tariffs, are a bilateral arrangement that has been made with most countries. It's not true with Canada, not true with Brazil, which also differentiates them. But most of them have been agreed. Now, would the Supreme Court really feel it was appropriate to negate a deal that had already been agreed between the two countries? That's a pretty heavy lift. So I would be very surprised if they ruled against.
Mr. Secretary,
I think it's more likely that you'll have a split decision, but they'll either let it stand or just knock out a few.
I wonder, though, on a broader level, this is a case about presidential overreach, about too much executive authority ruining a system of checks and balances that we as Americans have grown to cherish and respect. Are there any cases in which you're worried about this president using too much power in terms of executive orders, or in terms of stopping spending that the Congress has ordered, or in terms of sending the U.S. military in to fight against our own citizens in our own cities, or in terms of destroying the SALT deduction that gives the states financial sovereignty? Is there anything you're worried about in that sense, or do you think that this president needs more executive power?
Yeah, I think the question of use of executive orders is not unique to President Trump. Joe Biden certainly used a lot of executive orders himself. And so this is not necessarily a partisan issue. You can question what he's doing with them, but the subject matter of a lot of his executive orders is the same subject matter as President Biden had. They just came out in different sides on the issues, like EPA and other things of that sort. So I think it's a little more complicated than that. But in this case, I don't believe will be viewed by the Supreme Court as their opportunity to define executive power in general. The Supreme Court tends to stick to the four walls of what's before it, and that isn't really what's before it. What's before it is, in these instances, did the president have the power under IEPA to unilaterally impose the tariffs without going back to Congress? Then the complication there is obviously constitutionally the Congress has the power for tariffs. So this is a very specific combination of legislative history and facts, and therefore I would be very surprised if they used it to make a sweeping interpretation of executive power.
Well, we appreciate your experience and your wisdom. Mr. Secretary, thanks so much for your time this morning. Former Commerce Secretary Wilbur.
Let's see how it turns out.
Wilbur Ross. Yeah, we will watch and bring you all the headlines as they come across the ticker. Coming up, Brooke May of Evans May Wealth staying optimistic on stocks heading into the end of the year. She joins us next. This is Open Interest.
A check on markets just about 50 minutes into your trading day, and we are moving higher, both for your stocks and yields. Yields may be the more notable move this morning, and maybe notable it's not impacting stocks more. 10-year yields up 5 basis points, similar for the front end of the curve, moving to their highest level in 2 months after prices paid on ISM services surges to the highest in 3 years. Joining us now is Brooke May, Evans May Wealth Managing Partners, and she writes, we remain optimistic heading into year end. That said, some volatility would not be surprising before markets potentially rally into year end. Brooke, I mean, was yesterday that volatility? We dropped, what, a little bit more than 1%, but we are back higher this morning.
Absolutely. In fact, I'm surprised to see the market relatively flat today. We've had a parabolic move since April, and you would expect some cooling at some point. That said, looking out to next year, we think earnings could be up 14% in 2026, which, with that becomes market performance. So we think the market could end this year around 7,000, and next year the S&P go as high potentially as 7,700 by year end.
Are there areas, Brooke, where you're rebalancing your clients' portfolios, where you're taking some of the wins and buying what you think might be undervalued now?
We still like big tech, and we've got quite a bit of big tech, so we'll continue to hold those positions. However, right now we think it's an opportunity to add quality to the portfolio. So for those that are just getting invested, those that have been maybe sitting on the sidelines, we think you want that big tech exposure because you want the earnings. But in addition to that, valuations are high, and with the high valuations comes greater risk. So we wouldn't be surprised if we do see a little bit of a sell-off, and in that case, you want quality names.
Julian Emanuel has been writing about the potential movers for a sell-off of Evercore ISI, and he says until the 19th of this month, when we get NVIDIA earnings, the thing to be driving this market would be a government shutdown because of food insecurity, healthcare insecurity, air safety issues, military pay. He says that the consequence of the longest shutdown on record could be an S&P 500, which takes a beating. Brooke, so far we haven't seen really any market consequences of a government shutdown. Do you agree with Julian? Could that change?
The longer the shutdown goes on, the more risk there is. Right now, everything is hinging on the labor market. And the labor market has been the backbone of this economy the last few years. In fact, unemployment was below 4% for about 2 years. Since then, it's ticked up to 4.3%. And once we see the government reopen, we could see unemployment tick a little bit higher. In the last few weeks, we've seen 82,000 layoffs announced by S&P 500 companies. And more recently, Indeed indicated that there are fewer job openings than there have been. The one thing boding well, though, for the labor market is that we do have less immigration right now, in addition to demographic trends that aren't favoring labor supply. So with a reduced amount of supply, the fewer job openings shouldn't be as detrimental as it could be.
Are you taking any credit risk right now, Brooke?
Mm-hmm. A modest amount. Again, we're optimistic on the economy, but I think you have to be selective, especially when it comes to private credit. Right now, the buzzword has been private credit. And those are companies oftentimes that aren't publicly traded, therefore they don't have necessarily as much stability. And a lot of the private credit funds out there are even using a turn of leverage, sometimes two. So in this space, you need to know what you own. And while you can take some credit risk, we don't think it's a good time to go into something like high yield or leveraged private credit.
All right, Brooke, great to get some time with you. Really appreciate it. Brooke May there of Evans May Wealth. She was ranked by Forbes as one of the best in-state wealth advisors for years and years. Still ahead, Wall Street bonuses are set to jump for the second year in a row. We'll speak with Chris Connors of Johnson Associates. This is Open Interest. Get a quick check on the stock market today after the pullback we had yesterday, a little bit more than 1%. We're looking at gains now, a third of 1%. You can see we've climbed from the open. The breadth is still pretty evenly split. 259 stocks up, 243 down. This is the move screen. I think it's the most dynamic way to look at the index. The big gainers are Broadcom and NVIDIA. So after the warning that you may have thought we got from AMD yesterday, it doesn't seem to hurt those chip makers. Palantir and Apple on the downside. In terms of the industry groups right now, we're looking at communication services, which are those big hyperscalers ruling the roost. Energy materials up as well. On the bottom, utilities, consumer staples, and real estate. So those defensive sectors are off. Coming up, BlackRock's systemic business delivering outsized returns for investors over the past 4 decades. We'll speak with Mike Pyle and Jeff Shen. This is Open Interest. BlackRock's systematic business is celebrating its 40-year anniversary this year, with over 90% of its funds outperforming peers over 3- and 5-year periods. Joining us now around the table, Mike Pyle, Deputy Head of Portfolio Management Group at BlackRock, and Jeff Shen, Co-Chief Investment Officer and Co-Head of Systematic Active Equities at BlackRock. Gentlemen, thanks so much for joining us. I've been working on this for a long time, so I'm excited to get you here with us at the desk. Talk to us first about why you're here. I mean, you're hosting, I believe, a hedge fund conference, and you've got STA, which is your flagship fund that's been just building up momentum and crushing skulls over the last 4 years.
Thank you for that. I think 40 years always a good excuse to have a bit of a celebration. It's certainly about looking at the past, looking at what has been accomplished, but it's even more exciting to think about what's on the horizon. I mean, to your point, on the hedge fund business, I think that's given where we are in the market, where we are in the cycle, thinking about market neutral and also thinking about multi-strategy as a potential addition to most of clients' portfolio is certainly something that we're excited about. I think there's also a new way of thinking about investment, whether it's you call it using alternative data, using machine learning, using artificial intelligence. That's probably another way of try to think about this 40-year of history, which is full of innovation, but more importantly, to think about how do we use these modern tools for investment going forward.
Jeff, can you just quantify for us, because I don't think a lot of people know or understand how much money you run in terms of hedge funds at BlackRock, right? What are we talking about with these products?
I think that's a Mike question.
Mike?
Yeah, so BlackRock All In, we manage about $90 billion of client assets in hedge fund strategies. About $35 billion of that is through our hedge fund solutions business, but the lion's share of that is in direct hedge fund strategies like what Jeff and team run out in San Francisco and London in our systematic effort. I mean, if I might, just one additional point, kind of echoing Jeff into your first question, I think one of the things we've observed in the industry over the last 10 or 15 years is, 10 or 15 years ago, there was this view that hedge fund alpha was the domain of niche strategies, the domain of specialists, that scale and size were the enemies of alpha. I think the past 10 or 15 years has really turned that on its head. And when you look across the industry, scale has been driving alpha through data, through portfolio optimization, through risk management. That's an industry-wide story, but it's also a natural strength of BlackRock. So in a sense, we see both through systematic and more broadly the industry coming to where we have been.
The industry, and this is kind of the point you both are making, is going through a lot of change, especially with the technological and data advances. Jeff, I'm looking at a slide from one of your write-ups talking about using AI to seek investment returns. And the BlackRock systematic strategy, its predictive value on earnings calls was 61% for predicting a post-earnings market reaction. That compares to 55% for ChatGPT-4. I seem to remember a certain Citadel founder, Ken Griffin, saying that AI does not deliver alpha. Does this in itself argue against that idea?
Somewhat, but I'll say that in a more serious way. I think to your point, I think it is actually a fundamental question that all of us need to ask. How can AI enhance our return or potentially manage our risk a bit better? In the specific example here, I think it's really talking about using large language model to read through thousands of earning calls, broker reports, financial news, or the very session that we are on right now, to use large language model to process this information to try to make better prediction. So I think and that technology in itself is evolving so much. So I think it's a bit early day to say there's no hope in that. We're actually super excited about it, and it benefits our clients in the sense that we've done this for 20 plus years. We started to look at natural language processing back in 2007. So it's been a long time in the making, and large language model just turbocharge this set of it.
So you were ready for this, but I'm not sure if any of us expected it to be, this much of the focus for Wall Street. I mean, Mike, you spent years in the White House, working on policy, global economic policy, and if I had told you we were going to have a president who was going to put huge tariffs across all of our trading partners, and the government shutdown was going to be the longest that we'd had in history, and everything that's happened so far doesn't seem, under the Trump administration, to matter at all to these markets. Why do you think that is?
So maybe say a couple things, and this has been one of the topics of discussion at our internal investment forum the last couple of days. AI is obviously transforming the industry, transforming the way we generate alpha. It's also one of the biggest macroeconomic and geopolitical issues facing the country, facing the world, and really understanding the dynamics of that competition between the U.S. and China for leadership in AI, and the ways in which that reverberates, including in our own industry and our own approach. That's been one of the really core conversations. And maybe just to kind of pick up on the last question as well, I think this is one of the ways in which I think what our systematic team has been doing is so important. It's not just bringing new technology, new techniques to delivering alpha. It's the way they've been doing that for not just quarters, but years and decades or more, and also bringing human beings together who have deep expertise in these fields over years and decades working together to understand how to really define and explore that frontier of innovation.
Well, Mike, to that point, one thing that you are doing different than the hot flavor of hedge funds right now is you're not a pod shop. Pod shops have become so deeply popular. It's kind of like the model. I mean, you could debate whether that's good or not, but my question is talent, because surely people love to come into pod shops because they're like, great, I get to run my own money. I get to make the decisions of what actually to invest in. Is it hard to grab for talent when that big, shiny pod shop offering is out there?
So Jeff should speak to this as well, but I would say from where I sit in BlackRock, the culture that Jeff and team have built in the systematic effort is really one of its key differentiators and hallmarks. They really work in a space that brings together computer scientists, but also economists and finance experts. And it's that idea of having a really big canvas, really exploring the world and different types of expertise on that canvas, and the magic of identifying ways in which those forms of expertise can come together to generate alpha, including through much new and different technology techniques. That's the magic, and people are attracted to that culture, attracted to that approach, and they want to come work and be a part of that precisely because of that.
There are many different ways of trying to cultivate innovation, and I think from our perspective, is collaboration can be a way to cultivate that innovation, especially if we want to do things, to Mike's point, across disciplines. It's actually very important not to just put your headphone on, focus on the screen. That's one way of doing it. But there are also ways of getting 200 plus people in the systematic team at BlackRock to work together so that the clients would benefit from the scale.
How do you do that? I mean, I'm always interested in leadership philosophy and the culture, especially in a post-COVID era, right, when you're spread out regionally. How do you run your teams?
Yeah, I think it's, we're very flat from a structural perspective. And it's also, I'll say that there are people who have been around for a long time who can play the mentor, the leadership role, but then they're also exciting 23-year-old just graduated from college who can wow us with the latest and greatest. So I think it's really this combination of people who are experienced, people who are new, but it's also having this flat structure. I think it's almost Silicon Valley-like, if you will. It is really, a little bit less Wall Street, a bit more Silicon Valley.
Maybe the other Silicon Valley thing is the immense amount of data that you're bringing in and trying to analyze. Jeff, when you're looking at new data sources, how do you evaluate what gives you meaningful signal and what is just noise, especially given the predominance and the explosion of things out there?
Absolutely. There's a lot of noise, and I'll say that the numbers is such that every year we probably look over 1,000 data sources, and we'll probably test out about 200, but eventually probably only 20 or 30 actually come through. So it's really finding the needle in the haystack. But at the same time, it is also try to scale up the data effort so that you get more and more differentiated data sources. So there's really, from that perspective, data is a new oil, and we're definitely going at it.
You have 1,000 signals, did you say? And I guess that helps you look at things systematically, hence that's your remit, and it's in the title. But you still have to deal with this kind of volatility, shifting regimes, politics, regulation. How do you marry your experience in Washington and on Wall Street to do that?
Yeah, and this is something that Jeff should speak to as well. But I think I am in regular conversation with my colleagues on the systematic effort. And I think one of the things that's been exciting to see is the way in which, for example, machine learning techniques have been really powerful at identifying pretty fast-moving regime environments, and as a result, lead to changes in the way hedge fund portfolios are optimized that are responsive to changing conditions in Washington and around the world, but using the most advanced data and machine learning techniques to get from here to there in portfolios.
Just taking that, before you kind of add on to that, I'm also wondering, okay, you have all of this data and you have AI, putting them two together, is this a scenario where if you have the resources like BlackRock, you win, or is it like this is a big democratizing thing that anybody can get on ChatGPT and put all these things together and challenge a giant like BlackRock?
It's a bit of a both. I think there's definitely benefit of the scale that we can spend money on data, on compute, on different learners and different models. So I think there is that advantage. But to your point, there's also a lot of people have the access to the modern technology in their pocket. Everybody's got a deep neural network in their phone. So in that sense, there's also that competition. So I think from our perspective, it's really about going the extra mile. So it's not about just stopping at the generic model that you just can bring from the shelf. It's about how do you train the model with your specific data. It is about the care and the details. And it's actually really the last mile that's going to make all the difference.
I know you can't share any secret sauce, but are there any signals you've been getting recently that are interesting? Any factors that are working that have surprised you?
I think job market is actually an interesting one, right? We track the job posting data around the United States, 30 million job postings. And that actually gave us both a micro picture on which companies hiring, which companies actually hiring innovative talent. I call it, we are long Python, short Excel, even though I like Excel quite a bit. But at the same time, at the macro...
Nostalgia.
Exactly. There's also the macro level in the sense that we have actually, the overall look at a high frequency level on how the labor market is shaping up in the United States by the day. So I think in that sense, there are actually interesting data that you can ask interesting questions, and that's where the competitive edge is. So it's not about just using one technology, but it's actually putting the mosaic together, using machine to drive that scale.
This has been so interesting. Jeff, Mike, you're definitely going to have to come join us again. Congratulations on 40 years.
No more surveillance. No, I'm sorry, John Farrow.
I hope John's not watching that. All right, BlackRock's Mike Pyle and Jeff Shen, thank you so much for joining us. Coming up, Wall Street pay is set to climb as volatility and M&A surge. We speak to Chris Connors of Johnson Associates. That's coming up next. You're watching Bloomberg TV. For the second straight year, Wall Street bonuses are expected to climb. The latest report from Johnson Associates shows that market volatility and M&A are fueling the bumps. Here with more is one of the people behind the report. It's Chris Connors, principal at Johnson Associates. Chris, thank you for joining us.
It's good to be here, and a little birdie told me it's Matt's birthday, so happy birthday.
It is indeed, and he told me actually all he wants to do is talk about Wall Street pay for his birthday. So you are the present this morning.
I have to say, our viewers definitely love this topic.
They do love this topic. And I think one of the big questions in looking at this, Chris, is this a return to normal in the post-pandemic period, or is this the start of kind of a new boom era for Wall Street pay?
That's the seminal question. I think AI is going to be a big driver for that. I think it's the start of a new era of efficiency and productivity. I think our clients are really focusing on right-sizing their organizations from a headcount perspective to weather any downturns in the market or business downturns. So I think we're at a high point. We'll see what happens next year, but AI is going to be a big driver.
I was trying to think about this from a college kid's perspective, because if you're getting ready to go into the professional world and your main goal is to make as much money as possible, you want to know which field you should choose. So who's doing the best, and is it sustainable?
I think the skill sets that are needed of college grads today are changing rapidly. You're seeing a lot more people going into computer science and those related fields.
It's so weird because that doesn't strike me as a Wall Street major. Right?
No, of course.
Greek classics make sense, but computer science, no.
This I think people need to be able to adapt. So not everyone's an AI expert, of course, but you need to demonstrate that you can learn at a basic level how to use it. You have the tools in place, and you can show that your job, combined with critical thinking, is still valuable to a company. So everything's evolving in real time. I think the plane is being flown while it's being built at the same time.
Which is always a good thing.
Exactly.
It reminds me of, we had this excellent story, our banking and tech team, that OpenAI hired a bunch of bankers from all the bulge bracket banks and is working on software to do the work of analysts and of junior associates. Do we really understand what this industry is going to look like in 10 years' time, maybe even 5 years' time, just how much it's going to be changed?
No, I don't think we do. I think those efforts are taking place everywhere. This is a conversation in every boardroom, at the executive level. How are we implementing AI? I think we're in a period where strategically firms are trying to come up with a cogent plan. They have the tools, as I mentioned. They have the platforms, but what's our plan? What's our long-term plan? I think training your employees to effectively eliminate themselves is a cynical way of looking at it. I think it's more, how can we utilize this to be more productive?
How important is the political, the regulatory backdrop? Because one of the things that we're seeing right now, helping Wall Street bankers get paid, is a huge boom in M&A.
I think politically the backdrop needs to be advantageous for M&A. As far as our clients are concerned, 26 and the backlog looks great for advisory. This year pay is going to be up. We're projecting 15%, but next year it could be up even more if some of the backlog comes to fruition. So certainly the political backdrop needs to be favorable. We'll see how this plays out. But as of right now, there is not a concern that business is slowing down on an M&A front.
Chris, great having you in. We have to get you back. Chris Connors there from Johnson Associates talking about Wall Street pay. This is an interesting turn. When we come back, we'll talk about an historic victory for Democratic Socialists. Zoran Mamdani here in New York City.
About that?
I mean, have to wonder if it's going to change the trajectory of their pay much at all. Even right here in New York. We're live from City Hall. Next, the capital of capitalism. This is Bloomberg Open Interest.
If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him. And if there is any way to terrify a despot, it is by dismantling the very conditions that allowed him to accumulate power.
And that was Zoran Mamdani delivering his victory speech after a decisive victory in New York City's mayoral race. Mamdani is set to speak again in the next hour, and we'll bring that to you live. Bloomberg's Miles Miller is down at City Hall right now. And, you know, Miles, we just did a piece on Wall Street pay. That's a cohort that may be pretty nervous about how this term goes. What is Zoran Mamdani capable of?
Oh, he's capable of saying, Wall Street pay, give me more of that. That's what it seems. He is talking about using taxes on the wealthiest New Yorkers to pay for some of these proposals that he ran on, and then raising the corporate tax. We saw what happened in Illinois, right, when they raised the corporate tax, and we saw, you know, groups like Citadel moving to Florida. Will that happen here? It's highly unlikely. The case in Chicago is much different than the case here in New York. You know, JP Morgan made that big bet on putting their brand new headquarters building, building that new building there. They're not going to leave New York. So they have to figure out a way to work together. And you saw that from Jamie Dimon saying he wants to work with Mamdani. You saw the same thing from Jane Fraser saying she wants to work with this administration. You know, it's always funny to me when we talk about these big banks. You know, New York contributes so much money to JP Morgan because that's where New York's money is kept, right? If you're a city employee, you're paid from JP Morgan Chase. And so that relationship is going to have to continue. He will have to figure out how to write that script for that relationship because right now with the business community, it feels like there's a push and pull, some tension there, but he's sure to try to figure out how to fix that.
What about working with the federal government, Miles? We just heard from Mamdani there, soon to be the mayor of New York City, calling Trump a despot, saying any way to terrify them is by dismantling the very conditions that allowed him to accumulate power. Have we heard from the president since Mamdani's election? Just how much tension is there between the two?
We're sure to hear from him later on today, right? He spoke to those senators and he was speaking mostly about what was going on in terms of the government shutdown. But when he's in another setting, he's going down to Miami, I expect him to hit hard on these Democratic wins that happened last night. Now, it's important to note, you know, Mamdani and Trump both campaign on a message of affordability. But Trump is saying he's going to pull federal funds from the city just because Mamdani is a self-described socialist. Will that actually happen? It remains to be seen. You know, it's actually interesting. They talked about pulling funds from the 2nd Avenue subway and Gateway Tunnel, but we don't actually know if those funds were ever pulled. They never got a letter saying the funds were pulled. So, you know, he may say this thing in public, but does that actually happen truthfully? You know, it remains to be seen.
Miles, thank you very much. Miles Miller reporting from City Hall, and catch Bloomberg special election coverage kicking off at 12 p.m. New York time. That does it for Open Interest today, and I should just say happy birthday, Matt.
Thank you very much.
I hope you have a wonderful day.
Well, I'm certainly excited to listen to Balance of Power starting at noon.
Yes, that is a great way to spend your birthday.
It was an incredible day yesterday and truly fascinating results. So I'll be focused on what Joe Matthew has to tell me then. Coming up tomorrow, Ann Berry of Threadneedle Ventures, as well as Kate Moore of Citi, Elf CFO Mandy Fields, and the CEO of Shark Ninja. This is Bloomberg.